I'm going to turn this over to, I'm not sure who's going first, Jared or Jessica.
And Jess can take it.
Yeah, so first of all, I just want to thank everybody for joining. CAMCO has been a lockbox deposit client of ours since I believe 2013, so we appreciate the business. And if you have any questions as we go through our presentation, like Mary Ellen said, just go ahead and put them in the chat and we'll answer them as we go. It's always nice to have dialogue through these presentations instead of waiting till the end. So for those of you that don't know us, we are National Cooperative Bank. So you can go to the next slide, Mary Ellen. So NCB is about 43 years old. So we were kind of birthed the same time as around CAMCO. So we have developed a reputation in the industry as being an advisor and a trusted focus for our clients. We've been committed to the market. We did our first co-op loan in 1980, our first reserve account in 1989, and then we did our first condominium loan back in 1992. When everybody was trying to figure out how to lend a condominium since it was unsecured debt. We managed about $2.5 billion in deposits, $5 million in loans on the books for over 5,000 customers, and we touch about 400 management companies nationwide. So we are a national bank. We do business in about 28 states across the United States. And we believe that our clients are critical to our success. We want to make sure that you have the right technology in order to run your operations. And so we're going to talk, first of all, we're going to do a little bit, talk about loan products, talk about the underwriting process, and then if you guys have any questions, feel free. Jared, do you want to talk about the loan products?
Sure. Make sure I'm not on mute. Yeah, thanks for having us. Typically what we see in the industry are, one of two things for one of two reasons. You'll have a fully funded fixed rate term loan, and that, can be anywhere from 5, 7 to up to 20 years. It's paid back over the same period of time. So you start paying principal and interest right away. The loan funds at closing are advanced into an escrow account that you then draw from as the project or projects require. That's really for a project if you have a really good idea of what the final cost is going to be, right? Within a realm of reason, right? Because you're going to fix the interest rate right away, start paying principal and interest right away. It's really going to be your lowest cost alternative. The other option is what we call a draw to term loan, where you take, what in essence is a line of credit for up to 24 months, and you draw down on a loan amount as you need it and pay interest only during that period of time. And then when the project is complete, then you start to what we call amortize it or pay it back over a between 5 and 20 year period. Those alternatives are really good if you think there's a large variation in what the final project costs are going to be, right? If there's a situation where you need to do a decent amount of destructive testing before, and allows you to, say you get a loan for the worst case scenario, but your engineer or your architect or the contractor tells you there's going to be a pretty big variation in the final cost due to conditions at the community. The draw to term loan, gives you the ability to not borrow too much, right? You could qualify for the worst case scenario. Say if it was going to be $1 million was the worst case, but there was a good chance it comes in at 600,000 or 700,000 if the conditions are good. And so those are really the two different options. And Mary Ellen, are you keeping track of the questions, or should we?
Yeah, we'll field them. We'll kind of, if it's relevant to what we're talking about. Let me see.
Yeah. If somebody had asked, so we can do draws longer than that, which is I'm glad you asked, actually, because it reminds me, one of the components of a draw to term loan is just like a line of credit or a home equity loan or something like that, the interest rate's going to fluctuate during that draw period. And so if you wanted to do a 3-year, you could, right? The issue is, your final interest rate of what you're going to be paying during the payback period is going to vary, right? You're not going to be able to lock it for that 3-year period if you were to go out further. So there's amount of interest rate risk involved with the draw to term option that you don't get if you're going to fix the rate and fully fund and start to pay back the loan from day one, like you get with the full fixed term loan option. Hope that helps.
Yes, it does. Thank you.
Put my glasses on here.
Okay, so we're going to go on to the underwriting guidelines. So when you have a financing request that you submit to NCB, these are pretty much the 6 guidelines that we look at to pre-qualify you. So first of all, we want to see a minimum of 20 units. Once you get under 20 units, there's a higher risk for the bank for the payback, right? Because if there's fewer units to spread that debt service payback over. So if you have 15 units and 3 people are delinquent, it's pretty significant than when you have 60 units and 3 people are delinquent. So we like to see a minimum of 20 units. Now we've done loans under 20 units, and everything has to kind of check the box. We want to make sure that it's a secure loan in order to move forward. One of the most important underwriting criteria that we take a look at are your delinquencies. So we don't like to see, compared to your annual budget, more than 10% dollar amount delinquent, and then no more than 15% of the units delinquent. And as you get to those guidelines, we start to take a deeper dive to say, okay, what's happening here? Is there a concentration of unit owners that are making up this delinquency that's making your bottom line delinquency number significantly increase? So we can say, let's say you're at 15% delinquency, but I can pick out 3 homeowners out of 100 that aren't paying. And then we're able to underwrite it with that vacancy of those 3 homeowners to see if it's still a viable loan to the bank. We like to see your reserve balances greater than 10% of your annual income. Owner occupancy. So for this webinar, most are located within a major city, Philadelphia. So we like to see owner occupancy 50% or greater. As we get out into the suburbs, we like to see owner occupancy at 70%. And then the minimum loan amount that we do is $100,000. And that's because once you get to 100,000 or under, it almost makes that sense just to do a special assessment at that point. Jared, you want to take this?
Sure. Yeah, so I mean, we'll tell you a little bit about the benefits of NCB. We're happy to look at, first of all, thank you all for your business. We are your primary, lockbox bank. But in the event you had reserves at another bank or something like that, we're not going to require you to bring them to NCB in order to do a loan. We don't charge any application fees. We're very familiar with CAMCO's financials. We think they do a really good job. So we don't require audited financials for any loan, $1.5 million or less. If for the bigger loans, we do like to see audits or audited financials from the communities. And we can typically, get you what we'll call like a pre-qualification or a scenario analysis pretty quickly, right? So I think you don't necessarily need to wait until you have, your project fully baked to start to think about financing. We're happy to take a call from any CAMCO customer, even to just kind of brainstorm and say, will you send us a spreadsheet? We do it all the time, showing a board what's a $500,000 loan look like? What's a $750,000 loan like? What's $1.5 million loan look like? And we can put it at various terms, right? What's a 10-year payback look like? 15-year payback, just to help you with that decision-making process. We really try and be more of like an old school private bank for this industry. This is really this is the only thing our team does. It really specializes in financial services, both credit and deposit products for condominiums, homeowners associations, co-ops, and then the management companies that service you guys.
Funding projects with loans. So we're going to talk about how, why, and everything in between. So before you jump on and you decide to do a loan, the first thing we always say is start talking about this early. Bring in your attorneys, bring in your CPAs, bring in your managers. Everybody has something to add to this process, and it's nice to have everybody thinking along the same lines. The first is, do your governing documents address a loan? So one of the first conversations that we have is, we'll ask you is, do you need a vote of your membership to move forward with your financing? And a lot of times, some of the older governing documents are silent on that as well. So it's great to start talking with your attorney, get their perspective. So what you don't want to happen is you get to the commitment stage and you're trying to close this loan, and the association's attorney is trying to write their opinion, and they come to you and say, hold on, wait a minute, I think you're going to need a membership vote. And for any of you out there that have tried to get a vote, even like for an annual meeting, for these larger communities, even for the small ones, it's very difficult. It takes time, it takes multiple notices, it takes knocking on doors. So it can really delay your project if you have something lined up and ready to go. Is the loan appropriate? Like, what is the purpose of the loan that you're looking for? Does the project need to be done? What is the size of the loan that you need? A lot of times people will come to us before they really understand the purpose and the size of the loan. So it's nice to use your reserve studies and also talking to your engineers for these larger projects to help you determine what the size of the loan is. Because a lot of times, when you come with the loan amount, let's say it's $1 million, you think that's what you're going to need. And then all of a sudden you get your final bids back, the loan is closed, and then you need $1.5 million. So you have to come back for another $500,000. So there's pros and cons. So some of the pros for financing a capital project with an association is it allows the cost to be spread over the term of the loan. So instead of having these residents take a hit to their own equity and having to come up with a lump sum of money for a special assessment, you can amortize this cost, let's say, over a 10-year period. And a lot of times, homeowners would want, there's two ways to look at it when you have a loan. There's some associations that will want to allow the option for homeowners to prepay their portion of the loan, because let's be honest, there's people that just don't like debt. And they want to make sure they just have it paid off. So there's different ways to handle it. You can allow the option for residents to prepay, or residents then just to take part in the loan. Monthly costs can be transferred to new owners. And this is something that I think changes on association to association. Some associations will have that loan payment then transfer to the next homeowner, and then some will have it paid off at settlement. And that's something that can be talked about internally. We always say it's nice when you start talking about financing capital projects to reach out to your local real estate agents in the area that sell within your community. Let them know what's going on, get their perspective. It's always helpful to have that. Some cons that we talk about. So it's a long-term commitment. If you're financing, let's say 3, 5, 10, 15, even 20 years for some of the larger projects, we would include in that for like a large facade project, a roofing project, things of that nature. Often requires a vote, which we talked about before, which can delay the project if it hasn't been thought about prior to the financing. Additional cost versus cash from owners. So there are additional costs to financing. There's the bank's legal fees. You'll have your association's legal fees. And for Jared talked about earlier, the two types of loans. So the fixed fully amortizing loans that we talked about, for loans that are under $1 million, our bank legal fees are right around $1,500. And then for anything over $1 million is usually around $3,500 now that's just the bank's legal cost. And then your attorneys will charge you additional legal cost on that. So again, it's always nice to talk to your attorneys as well early to get the big picture of what it's actually going to cost the association. Can you benefit from a loan? So loan cost versus potential savings. What is the loan going to cost? We talked a little bit about that on the previous side. How is it going to help save the association money in the long run? And a lot of times we talk to associations, let's just say you have a roof project, and originally before they started thinking about financing, they had it divided up into five years. So when you decide to do a loan, you're actually able to mobilize one time. You're actually able to buy all your material one time and spreading it over a 5-year period where you could have material increases as well. And especially right now in a time of inflation, when everybody's experienced costs that have risen, there is a potential savings to be able to mobilize one time. Budget implications. How are you going to pay back this debt service? And there's a lot of different ways to look at it. Are you going to include it just within your operating budget? Are you going to do a special assessment? Are you going to take a look at what your current reserve contributions are? And let's say your reserve study, you've been saving for a roof replacement. So you can take a percentage of your current reserve contributions and put it towards your debt service since you were saving for the roof replacement. And that's something that NCB can always do for you, is kind of help you model out that reserve study to figure out, can you use a portion of those proceeds that you've put away for that year? Resale.
Jess,
Yep.
a really good point. I think we just did a webinar for a group of people last week talking about, historical inflation and the type of inflation that, communities should be using when forecasting capital projects. If you look at a lot of reserve studies, they've historically used, 2%, 3%, 4%. We actually did some research going back 20 years and found that if you forget about that headline inflation number and actually look at the types of inflation that impact communities on the capital or CapEx side or capital project side, construction, labor, energy, when combined, all were at least 2x of what that headline inflation number was. And so it's really, I think it's really important to kind of spread the word in the industry that when you are looking at projecting out your capital reserves, use relevant, inflation, being that these are primarily construction related, materials related, commodities related, that headline consumer price index is normally irrelevant. And we've kind of done a research study, and the reality of it was, your dollars are just eroding away at such a rate that in reality, you're actually saving money by borrowing money, because typically you're able to borrow money for less than that higher cost inflation, right? And then you're getting the project done sooner, right? So you can negotiate with a contractor, to Jess's point, mobilizing once, right? Even if it's going to take 18 or 24 months to get the project done, and even if it's going to cost 4 or 5%, to pay back the loan, that's still a lot less than 6, 8, 9, 10% inflation. That again, I think what a lot of people forget is inflation compounds annually, right? And so when you look at it that way, I think especially, given what's happening in the world today, we're seeing a significant inflation spike. It's really just bringing to the front page what has really been impacting this industry for years. So I figured that it might not be a bad segue to kind of mention that, because I think it's something that's a little bit of a twist on what we've traditionally talked about. Sorry, Jess.
Oh, no, that's fine. So continuing on, resale implications, which we talked about briefly earlier, how you're going to actually sell this to the community, right? Is the debt service going to be part of your operating budget, or is it going to be an assessment, and will it carry on to the new owner after the home is sold? Letter D, I think, is one of the most important issues to think about, is homeowner lender concerns. For any project, how are you going to get the buy-in from your membership? What is the process in order to do that? And I think it's really starting that conversation early, making sure that the membership has a full understanding of, first of all, why the project needs to be done, what happens if it's not completed, what are the benefits of the project, and more importantly, how is it going to increase their value of their home? And we've been to, Jared and I have been over the years to a lot of annual meetings where sometimes the first annual meeting that the membership comes to is the first time that they've ever heard of the project. So I think the more awareness the membership, your membership has, and the more they feel like a part of the process, I think the more buy-in that you have. And then again, community demographics. So if there's a community that has a fixed income, it's something to think about, right? With your debt service, is the community going to be able to afford that debt service? Okay, so are you a good candidate? Think about your delinquencies. Think about your owner occupancy. How many units are at your community? And then your reserves. Like this says, sometimes dead broke may be too late. So you want to start thinking ahead of these projects before it's too late. And then your management and board history. And we always say, dial a banker who specializes in this industry. They'll be able to bring a perspective to the table, be able to look at your financials, look at your delinquencies, be able to tell you, are you going to be able to get pre-qualified? It's nice to know, before you actually need the project completed, that you're pre-qualified, you're not going to have any problem with your financing. It's one less thing to think about as then you continue on with your due diligence for your community and your project. So what we did here was just did a sample scenario of a loan structure to show you the difference between a draw to term and a term loan. Now the term loans for $500,000, the draw to term, we did a 12-month draw. So if you take a look, you can see, like Jared said earlier, the draw period interest rate, that will fluctuate throughout that draw period, usually based on prime plus a spread. And then the term loan, you can see, is based on the term loan and actually the draw to term, your 10-year US Treasury plus a spread and then an interest rate floor. And we're able to put together these sample scenarios. Even if you just call me one day and you say, hey, Jess, we're thinking about doing a $500,000 loan. Can you put together some sample scenarios so I can have those for my board meeting, and then we're able to take a look. And then if we decide that it's something that we're interested in, you can take a look at our financials at that time. That way you have an idea of your estimated monthly payment, your annual payment, and what you're going to pay for your total interest cost. So the loan process. This is proposal, underwriting, commitment, closing, and draws. So typically we can get this done, I would say on average around 60 days. So once we have a signed proposal from the association, we're able to start collecting the underwriting items at that time, and we get a full package. That package is then submitted to the underwriting team. And then once we have the approval, you're issued your commitment letter. At that time, you typically send your commitment letter over to your association attorney for a quick review. Once they sign off, then we and you're comfortable, then we transition it over to the closing department. Jared, you want to take this one?
Sure. Yeah, I think, a lot of times, what we see is everybody wants to help, but it's important that there's a team, internally. What we call them are like deal teams, right? Who needs to be at the table, for these projects. And I think to Jess's point, the earlier the better, just to make sure, are you able to obtain financing? And if so, what steps do you need to take? So there's your lawyer and your banker. I think communicating is really key. The communities that we've seen that communicate early and often, especially nowadays, you can text, you can email, you can do little pulse surveys, right? You can send out images and mock-ups of what the final product's going to look like. I think the more you get your community engaged, the more they feel like there's this perception in the industry that we hear all the time, where it's like, the board went and did this thing without anybody knowing, and I think the reality of it is the boards most boards are doing a decent job, right? It's a tough job, it's a tough role, it's a volunteer job, but I think, in absence of communication, a lot of residents just assume the worst. So I think the more you communicate with them, and nowadays, you've got these systems, I'm sure CAMCO can help you out, where you can email the residents, you can text the residents, right? The residents can determine whether they want a text or they want an email. And so letting them know what goes on, then there's just really no surprises. And I think that, one of the most important pieces, of your deal team is really just finding like an engineer or an architect. A lot of communities, I guess, recoil from additional costs, right? But the reality of it is an engineer can help you with your best, worst case scenarios from day one, right? What we see over and over again are communities pushing on their managers to just go and get bids for everything, right? But the reality of it is bids without any sort of specs or an engineer and architect looking at them are only, typically worth the paper they're printed on. And I think it's really worth the additional funds to get an engineer or an architect involved. If CAMCO does a lot of work for a lot of people, so if you want, you can probably get them to get kind of a fixed price for at least preliminary reviews, so it's not time and materials, and it doesn't become a runaway cost. But again, I think establishing a deal team, making sure your manager is aware of it, making sure your management company's accounting department is aware of it. I think a lot of times, speaking, I don't want to speak for CAMCO, I'll speak for all the customers we have. It's crazy how many times we get a call from a staff accountant saying, this loan closed last month, I need to make a payment, right? Like, what's the amortization table? What were the fees, right? Like, just to create that audit trail. A lot of times they're the last to know. And I think, they don't need to be, as involved, but they should be aware.
So I think it's important, no one size fits all, that the loans may only be part of the project. And we gave an example down here for a $2 million facade project. So in this example, the community did a one-time assessment of $500,000. They did a loan of $1 million, and then they used $500,000 of their existing reserves to cover the full cost of that project. So then their debt service was amortized over a 10-year period for the $1 million loan amount. And this is all stuff.
If I can remember what this project was about, it was a community that had a decent amount of people on fixed income, right? They preferred, when they were engaging with the community, they heard that there was an interest to pay some of it up front to keep the loan amount down. So the community took some money out of reserves, and then residents paid a little bit up front, and that way it kept the debt service or the loan repayments were actually able to be paid out of their annual reserve contributions, right? So they didn't have to raise fees in this instance. It was just a one-time assessment.
So comparing loan proposals. So when you have large projects, you're going out to a couple banks. to get the pricing and the structure. So once you have these proposals in front of you, what do you do at that point? So what we did was pull out about 6 bullet items that I think are the most important when you're reviewing these proposals. How is the financing priced? Do you have a fixed rate? Is there a floating rate period in there? I was just talking to a manager the other day that we had priced a 15-year fixed fully amortizing loan. And we were talking about the rates that they were seeing, and she was saying a better rate from somebody else. And then we started talking about the structure, and that other bank had priced a 15-year that had a reset rate at year 10. So it really was truly only fixed for the first 10 years. And then that rate reset for the last 5 years. So those are something to think about. See if it's fixed through the whole term, if there's a reset rate, or if there's any period where there's a floating rate as well, which is your adjustable versus your fixed. So during that draw period, is it adjustable? What is it based on? Is it prime plus a spread? When does your actual amortization rate fix? Does it fix after that draw period? So if you have a draw period for 12 or 24 months, and it's adjustable, and then your amortization rate doesn't fix until after that, there's no way to predict where the interest rates are going to be in 24 months. Is there a floor rate, which would be the least amount that rate would actually be for that financing? Your prepayment ability. So you want to make sure with these association loans that you have the ability to prepay at any time with internal funds. So as long as the funds are coming from the association, you're able to make a prepayment, and then that loan will reamortize at that point. And typically you're allowed to prepay once or twice a year with your internal funds. Now there's typically a penalty if you go to try to refinance with another bank, but there should always be your ability to prepay with internal funds. And that also lends itself, so if you decided to do a fixed fully amortizing loan, and let's say you had a loan for $1 million, you ended up doing the project for $900,000. So at the end of that project, you had $100,000 sitting there in your escrow account. And that is considered your internal funds. So you can also use that as a prepayment back to the bank, and then your loan will reamortize. And then deposit requirements. So is the bank that you're looking at, are they requiring you to bring a deposit over to their bank? And as I think Jared mentioned earlier, NCB does not typically do that. And then also invite a banker in, let them sit down, go over the proposal, pick their brain, ask questions. And then we have put together a case study. I'll let Jared go ahead and do that one.
You know, I'll just make one note on the deposit requirement. I think a lot of boards might say, well, who cares, right? If this bank is asking for a deposit, their rate is lower. A lot of times that deposit's required for the whole term of the loan, right? So are you willing to lock up your reserves for that period of time, right? So at a higher rate, sometimes you're actually paying for the flexibility so that your reserves are not locked up at one institution or another. So this was a 180 unit garden style community, 10 3-story buildings, 51% owner occupied, low delinquencies. You know, they were redoing their piping for fire suppression, roof replacement, window replacement, masonry repairs, and then EFS, right? I think this is a good example of, you don't have to do, one project for one loan, right? And one of the advantages of financing is you could kind of bundle a bunch of trades and have them all happening at one time. So the final decision these guys made is the size of the loan grew to $2.5 million, and what we did is gave them a line of credit in addition to the $2.5 million, and that was to cover their contingencies, right? That way, if the project got a little more expensive, they could use the line of credit and then pay that back as reserve contributions came in. They decided to pay it back over 10 years and funded that payback through an increase in regular assessments rather than special assessments. And this was an older one, so it took, it was a long-term project. And I think, bullet 3 is an interesting one. We get that question a lot. Do you have to pass an assessment for every loan? And the answer is no. And I think it's important to realize that, assessments have a negative connotation in the real estate market, right? If people know that there's a building that consistently has an assessment, and it's erratic, it's 1 year, 3 years later, 2 years after that, you'll actually see the values of that community, be less than comparable properties, right? Buyers like stability. They like to know that the property is well kept. They like that the fees are stable, even if they're going up, right? People don't like the shock of getting a big bill. And then the other thing to realize is you don't have to pass, an assessment, right? You can just build the payback into your regular budget and take the debt service out of your reserve contributions. And we're seeing a lot of communities do that because there's really no way, once you get to an older building with the inflation impact that we talked about over the past 20 plus years, there's no way you're catching up with a regular reserve contribution. You have to come up with sizable capital. There are buildings that are very well capitalized, but I'd say they're in the top 5, maybe 10%. The majority of buildings or communities have these, especially if you're talking about condominiums, mid-rise, high-rise. The only way to catch up is to have some influx of capital, right? And that's either through a large special assessment or a loan. And I think as far as the real estate market's concerned, they're pretty much indifferent as to whether a community has a loan or not, compared to their reaction if there's either an ongoing or the perception that there could be at any time an assessment.
Thank you, Jessica and Jared. And does anybody have any questions? You want to put them in the chat? I think they're going to stay around till we finish with the special assessment. So if you think of anything, put it in the chat and then we'll go through them. So next we're going to thank you. That was very informative. I'm sure everybody on this call realizes that. It's especially if you've gone through it, you learn something new every time.
Thank you for having us.
Yeah, that was really good. So next, Melissa Plymette is going to do the special assessments.
Thanks, Mary Ellen, and good evening, everyone. So we wanted to talk a little bit tonight about special assessments as well, which, in some cases it's the other side of the coin to loans, or, it might even be an alternative solution for a community that isn't able to take out a loan. So we want to just talk a little bit about that as well. So the purpose of a special assessment really comes into play when an association is faced with an unforeseen event or has an unexpected expense arise that they are not financially prepared to handle. And so in that case, the board would need to consider implementing a special assessment. So a special assessment essentially is a supplemental fee collected in excess of the regular monthly assessment. And it's typically tied to a specific project or expense that the association is incurring. It serves to provide the association with the additional funds needed for that project when they don't have sufficient cash on hand to cover it, or maybe even if they just don't want to deplete their existing reserves in order to pay for the project. So a special assessment can be implemented for both an operating expense or also a capital reserve expense. I would say on the operating side, the reason that we see community special assessed the most often is typically for overspending on snow removal. That's something that obviously is very hard to predict, and it's hard to really determine how much to allocate for snow. So if the association doesn't have an adequate cushion in their operating fund to cover, a really kind of heavy snow year, then you may need to special assess there to, replenish your reserves. So I want to talk a little bit about special assessment planning, some things to consider when the board is considering, implementing an assessment. So once the board decides that an assessment, special assessing is the best course of action for their project, they should begin planning to really determine how to assess and the timeline. If you're assessing for an upcoming capital project, you may be reviewing, multiple bids from contractors in order to determine the best vendor for the job. The board should ensure they're considering all potential costs associated with the project. This is going to include, contingency, which typically we see is in the 5 to 10% range. You don't want to get into a situation where the project goes over budget and you've only assessed for, maybe the exact amount, and you're unable to supplement through existing cash. So it's important to consider, all the costs that can come into play with a project, and really trying to, predict that before determining how much to assess. So the board should also consider cash flow needs. Part of the project be funded from existing reserves to reduce the burden on homeowners for having to, cough up essentially a large lump sum all at once, or as Jared and Jess obviously discussed, is part of the project being funded through a loan. So really determining the structure of the assessment and how it best fits with the project that you have coming up. So the board should also review the project timeline itself and the payment schedule required by the contractor to ensure that your assessment is properly aligned with the project. So for example, if the board's working on implementing an assessment and wants to spread it over a 2-year term to make it easier for homeowners to pay, but the work is going to be completed in the next 6 months, for example, you're likely not going to have the cash that you need when you need it to pay for the project. And then finally, you'll want to review your governing documents. Again, similar to a loan, there might be certain requirements for implementing a special assessment. So you might have a requirement that the board or the association has to have a majority vote in order to implement an assessment. Maybe it's a 2/3 majority. So you want to make sure that you understand, the requirements of the association's docs before, an announcement is made to homeowners, so that you make sure that you're, adhering to those requirements. And then, obviously it's consulting with with the association's legal counsel, if necessary, can be helpful to make sure that, you're following all the right guidelines. So once you've sort of, determined the parameters of the assessment, we want to make sure that we get the actual implementation of it, correct. Again, this goes back to reviewing governing documents and making sure that you're adhering to the guidelines. And so one thing there is to make sure you're giving homeowners as much notice as possible. Some associations actually have a requirement for how much notice you have to give prior to implementing a special assessment. It might be 60 days, it may only be 30 days, but making sure that you're following those requirements is important. So, just reviewing the governing documents there again. Another item to consider is make sure you're providing realistic payment options. Obviously it's not always possible. Sometimes you're really under the gun with a project, but if you have the ability, consider your current accounts receivable. If the association has a high delinquency and it's spread over numerous homeowners, and you're looking to implement a special assessment that's requiring a lot of money to be paid, very quickly on less than 60 days notice for example, you might have trouble collecting those fees, and then you may not be able to meet the payment terms of the project. So it's important just to consider the homeowner's ability to pay and the timeline of when you need the money. So you make sure that those those are matching. If you're planning fairly far in advance, you may be able to spread the assessment out over a few years to begin. And then in that case, you could begin collecting in advance of the project, which allows you to then build up your cash in advance. It takes some of the burden off of the homeowners for having to come up with, the funds on short notice. And then lastly, it can be helpful to, when you're implementing the assessment, to schedule a meeting with the homeowners, especially if it's going to be a large capital project, just to answer any questions or concerns. Obviously, telling people that you need them to give you money is never easy, but just being as transparent as possible about the project plan and how the project is going to benefit them as a homeowner living in the community can really just provide some peace of mind there. So I want to just mention briefly, the support that we can provide, on the management side when you're looking to implement a special assessment. The accounting team, we really have the capability to assist with, if you need some cash flow modeling done to figure out, like I was talking about, the timeline of the project. We can assist with that to make sure that, you have the cash on hand when you need it, and that you're not, inhibiting cash that you need for just daily operations. And then the manager, along with your AR team, with our AR team, will provide assistance with preparing the communication to the homeowners and making sure that, the payment options, whether it's, one option or whether you're offering homeowners multiple options of how to pay, that we're clearly communicating it. Communicating the assessment is important, but we want to make sure that the payment options are also, clear so that we make the collection aspect as easy as possible. For example, we always encourage boards, when possible, to communicate that homeowners who are set up on ACH, that for their regular assessment, that the special assessment also be collected that way. If we default to that, then it just really helps with expediting special assessment collection, so that you're, again, meeting your payment needs. So how to avoid special assessments? Obviously you can't predict the unknown, but there are a few things the board can do to help reduce the chances of needing to special assess. Careful budgeting, obviously, when budgeting, you really want to consider historical costs, as well as just making informed forecasts for next year's budget, just to help avoid, essentially running out of money, right? Being very familiar with your reserve study and making sure that it's updated every 3 to 4 years. The engineering firms that do these studies really analyze every component within the community and determine how much useful life is left. And so that's just going to help anticipate the timing of when those, when these big expenses are going to come up, and when they need to be, either replaced or repaired significantly. And then lastly, it's just important to know where your reserve balances are, how much you have on hand. Are you running an operating deficit that, you should consider budgeting to fund, to reaccumulate, reserves for the next year. And that's both on the reserve, on the capital side and on the operating side. So considering both of those will help ensure, or at least, hopefully reduce the need to have to special assess. And so that's all I had. I think now, we certainly want to open it up to any questions on either presentation.
Yes, we do have a couple questions. Someone asked, do you need a sizable reserve to qualify for a loan?
No, but what we like to see is, I think we talked about it briefly, is that the reserves aren't under 10% of your annual budget. And one of the things that we do during underwriting that I don't think we really talked about in detail was we take a look at your current reserve study. And if you were applying, let's say, for a 10-year loan, we want to know what other projects are coming up within that 10 years. Are they significant? How are you going to be able to fund them? And that's when we take a look at your current reserves and your cash on hand to be able to model that out and figure out. So if you're doing a roof replacement project and that's $1 million, but there's another $2 million of work to be done within that 10 years, we want to know how that's going to be handled.
Thank you. We have somebody, Rocco would like to reach out to somebody and set up a meeting. So we'll connect, Rocco, we'll connect you with Jared or Jess by way of email.
Sure, we're happy to help.
Thank you.
And then we have loan initiation fees. For example, 1% of a loan amount.
So for fees for your fixed fully amortizing loan, there typically are not any fees. We talked about the bank's legal fees at $1,500, and then there's typically a filing fee of $250. Now there is a commitment fee for your draw to term style loan, which is typically 1% of the loan amount.
We have somebody is commenting, 2 disadvantages of financing versus a special assessment, or all revenues are pledged until the loan is paid off and the financing cost is much higher than a multi-year assessment from owners.
So yeah, this is unsecured debt. So the only collateral we have is the income that's coming into the association. So there is a lien on your income until the loan is paid off. Hold on, I'm just reading the comment again. Financing cost is much higher than a multi-year assessment. Well, so for the multi-year assessments, yes, you're giving your residents, just like Melissa was talking about, a time period to pay a lump sum of funds. And then if you're financing, there is an interest on top of that, and there's different schools of thought to take a look at that. For multi-year assessments, you're having residents that have to take a hit to their own equity at that point. And then you say to yourself, so if you are doing a project and you're financing it for 10 years, but you only plan on being there for 5 years, do you really want to pay that lump sum multi-year assessment for the entire project if you're only going to be there for half of the time, right? And then you can pass that loan payment on to the next homeowner. So there's different schools of thought, and it really is just what the association is comfortable with.
And I think one of the things I like to say is, managing a community or being on the board of a community is like managing a mini municipality. And if your local township, right, wanted to repair a road or a bridge or a clubhouse roof, would they send you a bill for that? Or would they just manage it through their cash flow, their ability to borrow on the balance sheet at the community level? I think the one thing I completely agree as far as cost of capital, the cheapest way for the community is basically to borrow money from its current residents for free, right? But to Jess's point, you're taking a hit to your own personal balance sheet for a deferred maintenance item that's actually on the balance sheet of the community. So I would kind of challenge you to say, well, if you're going to take money out of your own pocket and lend it to somebody for free, wouldn't you be better keeping it in your pocket and putting it in the stock market or in bonds, right? And letting the community, just like a municipality, finance its own deferred maintenance.
We have, I think this is a similar question, monthly loan servicing fee, for example, 25% of the loan. I think, Jess, did you touch on that already?
After the loan closes, is that the question? There is no servicing fee after the loan closes. And again, you're fixed fully amortizing. There are no fees. The only fees would be the legal fees. And then your draw to term style loans will have a commitment fee that are typically 1% of the loan amount.
And Jessica's information is here if you want to reach out, her email and her mobile. Do we have any more questions? This was very informative. And if you have questions after the fact, you can always reach out to NCB or CAMCO. We'll be happy to.
Can I ask a question verbally?
Sure.
I'm Steve Moss. Does the entire loan have to be tied to a specific project. For example, we did something like this before, and we ran over by $100,000 approximate dollars, and that affects our reserve on an ongoing basis. So we're about to do a similar thing and request a similar loan or try to get a similar loan, but we'd also like to make up for that prior approximate $100,000 shortfall that we experienced before. Is that something that's realistic for us to plan on that basis, or does this just need pretty much to be tied to a specific new project, facade project?
They typically are new projects, but what we can do if it's something, are you talking about just kind of augmenting your reserve account for
In
that?
effect, yes. Yeah, in effect, yes.
So what we would have to do is just understand what the project was that it was allocated for during underwriting. And then we should be able to do that.
Okay.
Depending on the time period, as long as it's something that wasn't like 10 years ago.
Anybody else have any more questions? You can unmute yourself and ask. Again, if you have questions and you think of them after the fact, or you want to discuss your association in particular, you can reach out to us at CAMCO or to Jess and Jared at NCB. I also just want to let everybody know that the next board member roundtable is going to be May 10th. It's going to be on asphalt and concrete maintenance. McAdam is going to be presenting, so that should be good. We also have our Vanica training for our owners portal. That's going to be on May 12th at 12 noon. We do try to have these Vanica portal trainings, usually one in the afternoon, one at night. We try to have them throughout each month. So that's, if you have questions about that, just reach out to your manager. Thank you everyone for coming tonight. Thank you, NCB.
Thank